What if the biggest danger in financial markets isn't volatility but silence? What if one of the most powerful banks in the world quietly reversed a position so large it could reshape an entire market and almost no one asked why? For years, the dominant belief has been that markets move because of news, data, or sentiment. But today's story challenges that assumption. Because when JP Morgan executed an 800 million ounce turn, it wasn't reacting to headlines. It was reacting to pressure deep, structural pressure building beneath the surface. The mystery isn't whether this flip happened. The mystery is what conditions forced it, and what that tells us about how fragile modern markets may really be. To understand this stunning long flip, we need to understand how modern financial markets actually function, not how they're presented to the public. Today's markets are dominated by derivatives, futures contracts, and leverage. Vast amounts of exposure exist on paper, often far exceeding the underlying physical assets they represent. Large institutions like JP Morgan don't just participate in these systems, they help stabilize them, provide liquidity, and absorb risk when others cannot. For years, JP Morgan was widely known for holding one of the largest concentrated positions in the market. This wasn't accidental. It was part of a complex web of hedging, client exposure, and systemic risk management. But systems built on assumptions tend to fail when those assumptions change. And slowly, almost invisibly, the conditions supporting this position began to erode. The origins of the 800 million ounce exposure trace back to an era when liquidity seemed endless. Central banks flooded markets with capital. Interest rates remained low. Volatility was suppressed. In this environment, large positions were not just tolerated, they were rewarded. The more predictable the market appeared, the more leverage could safely be applied. Cause led to effect. Abundant liquidity enabled scale. Scale reinforced price stability, and stability justified even more leverage. For a long time, the system worked. But it worked only because the stress points hadn't yet been tested. As years passed, the position grew. Rolling contracts became routine. Counterparties assumed continuous access to liquidity. Risk models relied on historical calm rather than future uncertainty. The position wasn't just large, it became embedded in market structure. Unwinding it quietly would have been difficult. Maintaining it indefinitely, however, required something far more dangerous: confidence that nothing would change. That confidence didn't disappear overnight. It cracked slowly, then all at once. The breaking point came when physical constraints collided with financial promises. Supply tightened. Delivery pressure increased. Volatility, long suppressed, began to re-emerge. Suddenly, paper contracts were no longer abstract exposures, they carried real-world consequences. At this moment, JP Morgan flipped long. This was not a speculative bet. An 800 million ounce turn is a defensive maneuver. It signals a recognition that the risk profile had inverted. What was once manageable had become dangerous. Cause and effect converged. Rising stress forced a reversal, and the reversal revealed stress the market had not priced in. The immediate fallout wasn't dramatic headlines or instant collapse. Instead, the effects were subtle and delayed. Price behavior shifted, liquidity became uneven. Volatility appeared in places it hadn't before. Smaller players felt pressure without understanding its source. This is how systemic events unfold. The initial shock is absorbed quietly by the largest players, then distributed outward across the market. By the time the broader public notices, the original cause is already hidden behind secondary effects. In response, regulatory mechanisms adjusted. Margin requirements shifted. Market rules were refined. But none of these fixes addressed the core imbalance. The system still relied on a fragile assumption that paper exposure can always be resolved without friction. History suggests otherwise. When confidence replaces collateral, stability becomes temporary. Each fix postpones resolution, but also increases the eventual cost. Today we see similar patterns across markets. Derivatives exposure remains at historic highs. Concentration risk persists. Liquidity appears deep until stress reveals how thin it truly is. The pattern repeats. Leverage creates calm, calm invites risk, demands reversal. And when reversals occur at institutional scale, they don't just move prices, they rewrite narratives. So what can we learn from the 800 million ounce turn? First takeaway: when systemically important institutions change direction, it's not about opinion, it's about survival. Second takeaway: paper markets can mask physical and structural stress for years until suddenly they cannot. Third takeaway. The most important signals in finance often appear before headlines, not after. The warning is simple. Markets don't fail because of surprises, they fail because of ignored assumptions. And the open-ended question remains, if an 800 million ounce flip was necessary to manage risk once, what unseen reversals are being prepared today? If you found this analysis valuable, support the channel by liking the video, subscribing for deeper financial breakdowns, and sharing your perspective in the comments. Because understanding how these systems truly work is the first step towards seeing the next shock before it arrives.